Hi everyone, this is a technical analysis on EURUSD. Let's start with some fundamental background first. The Fed this week came out slightly more hawkish than expected, keeping interest rates unchanged at 5.25%, but adding 50 bps to the projected terminal rate in the dot plot. The FOMC decided to pause at this meeting to gather more economic data before deciding on another possible hike at the July meeting. Their caution may be justified by the weaker details in the latest NFP report, the ISM Services PMI, and the CPI report, although the core readings remain sticky at elevated levels. Fetcher Powell mentioned that the July meeting is live, but he didn't want to pre-commit. The market reacted with a quick bid in the US dollar once the dot plot was released, but returned back to the original levels once Powell's press conference began. Overall, it just shows that the Fed is ready to do more, but it will all depend on the economic data. Yesterday, the US jobless claims missed expectations once again by a notable margin, which may be another sign that the labor market is indeed weakening. The ECB raised interest rates by 25 bps as expected and hinted to another hike in July coming. Moreover, the ECB sources said that a further hike in September will be discussed in the summer. This has created a bit of policy divergence between the Fed and the ECB, ultimately favoring the euro. Now, on the daily chart, we can see that the Euro USD bottomed out once the Fed members signaled a June skip at the end of May, and the US data started to disappoint. The pricing out of the more hawkish expectations led the USD to erase the gains seen in May and eventually to tumble as the other central banks either surprised with rate hikes or signaled more to come. The moving averages have crossed again to the upside, which is a bad omen for the USD buyers. Yesterday, the price overstretched a bit following the hawkish ECB event, and is now back to a previous support, now turned resistance. Generally, when the price extends so much from the blue 8 moving average, we can see some consolidation or a pullback to bring it back into some equilibrium before the next move. Drilling down to the 4-hour chart, we can see that the buyers have landed on the red 21 moving average to position for more longs, and the price is now consolidating a bit at the resistance here at 1.0942. The price may keep on rallying today and extend all the way up to the 110.33 high, but from a risk management perspective, the risk to reward here is really bad. A good support level for the buyers should be the one at 1.0850, where we can find confluence with the red 21 moving average, the trend line, and the 38.2% Fibonacci retracement level. The stop in that case would be below the 61.8 Fibonacci retracement level, and the target roughly at the 1.11 handle. An even better support would be the above mentioned 61.8% Fibonacci retracement level, where the buyers would have a very tight stop below. The sellers, on the other hand, are likely to lean on this resistance at 1.0941 to target the trend line first, and then the support here at 1.0779. If the price falls below this support, we should see more sellers piling in and extend the sell-off into the 1.0635 low. Look in the 1 hour chart. We can see more closely the training setup for the buyers and the sellers. The buyers should lean on this 1.0850 support, while the sellers can either go short here with a stop somewhere above the high, or wait for a break below the trend line and this support to target the 10635 low. Today, the market is likely focused on the University of Michigan Consumer Sentiment Report. Last time, the market reacted heavily to it because long-term inflation expectations showed a big jump to the upside, rising from 3% to 3.2%. Later on, the number was revised to 3.1% though. So we are likely to see the dollar rising in case we see another jump in long-term inflation expectations, and falling in case the data misses forecasts.